Japan still isn't catching a break. In recent months, the land of the rising sun has been all over the financial headlines.
Yields on 20-year Japanese government bonds rise to new highs since 1999.
And not exactly for positive reasons. Things have gotten so bad that former Prime Minister Shigeru Ishiba has even said that Japan is as broke as Greece in the midst of the financial crisis. And I say former Prime Minister because he recently had to resign after poor election results, heavily influenced by the country's dire economic situation. After decades of stagnation, just when it looked like Japan's economy was finally about to take off, bam! The perfect storm hit. We've got all the ingredients for disaster. Inflation, skyrocketing public debt, soaring interest rates, political turmoil, and a central bank that no longer wants to keep fueling the engine. And here's a fact you can't ignore. Japan is the most indebted developed economy in the world. Its public debt equals 260% of its GDP. That's like taking out a loan to go to the casino. If you win, great, but if you lose, you're twice as broke. And we're not talking about just any country here. This is Japan, the land of Nintendo, anime, samurai, and the fourth largest economy on the planet, a crucial cog in the global financial machine. So what if that cog breaks? Well, it could drag the rest of the system down with it. That said, let's not hit the panic button just yet. Yes, Japan's problems are very serious, and in recent days, they've been growing. But Japan still has a few aces up its sleeve, and maybe, just maybe, all hope isn't lost. That said, let's get to today's key questions. Why is the debt rate skyrocketing in Japan? What are the consequences for the Japanese economy? And can this crisis still be fixed? Let's start with a crucial question. Is Japan really as indebted as they say? Well, no. Or at least not in the way many people imagine. To begin with, almost 80% of Japan's public debt is held by the Japanese themselves, and that Visualeconomik community is not the same as owing money to half the world. What's more, half of that debt is held by the Bank of Japan. But wait a minute, because we haven't mentioned the most important part yet. When you hear that Japan is the most indebted developed economy in the world, what they are talking about is a comparison of debt to GDP. And okay, that figure is impressive, but it doesn't always tell the whole story. Let's take an example. Vladimir Putin's Russia. Russia's public debt is between 16 and 20% of GDP, 7 times less than that of the United States. But do you know how much of Russia's public spending goes towards just paying interest? 3.5 times more than in the US. Why? Because for Putin, borrowing is extremely expensive. It's not that Russia is a model of Swiss fiscal discipline, it's just that it's unable to borrow. In Japan, however, the opposite is true. Borrowing is so cheap that the government can afford to have a very high debt to GDP ratio. But if we look at interest expenditure, Japan devotes just 8.5% of its budget to this item. Furthermore, unlike other countries, Japan is making an effort to repay the principal. In fact, it spends almost twice as much on this item as it does on interest payments. Does this mean that Japan does not have a problem with public debt? Of course not. The land of the rising sun has problems, and they're becoming increasingly serious. But we must put them into perspective. In a recent video, we talked in detail about what is happening. Understanding this is essential to understanding why the situation is becoming more tense with each passing day, and also to understanding what Japan can do to avoid disaster. But anyway, in case you haven't seen it yet, let me summarize it in 3 key points. We said earlier that Japan is the most indebted developed economy, at least if we look at debt in relation to GDP, because as we have already seen, the real cost of that debt is not so high. But what we haven't told you yet is that Japan doesn't just owe money, it also lends, and a lot. In fact, it's one of the largest creditors on the planet. Take note, Japan, with its 125 million inhabitants, holds more US Treasury bonds than China itself. Yes, you heard correctly. The land of sushi and karaoke has more US debt than the biggest country in Asia. This is explained by this graph. You see, the Japanese economy is very unbalanced. Its industrial sector has historically been one of the most productive on the planet. Remember, companies like Toyota and Sony were so feared in the United States that Ronald Reagan, yes, Reagan, the champion of free trade, went so far as to impose 100% tariffs on them. But of course, everything has a price. And in this case, the price was a rather lamentable service sector. This difference in productivity tipped Japan's trade balance toward exports. In other words, many more dollars were coming coming in than going out. And what did the central bank do with all that mountain of dollars? Exactly. It used it to buy foreign debt, mainly US Treasury bonds. And this brings us to the second key point. Since the 1990s, the productivity gap between Japan and the United States has only increased. What was once an economic miracle turned into a stagnant economy for decades. So how did the government respond? With the classic formula, issuing tons of public debt and keeping interest rates close to zero, or even negative. Here, the Bank of Japan has been crucial because it bought half of all public debt, and even though it did so on the secondary market, this helped keep the cost of debt in check. On top of that, insurance companies and pension funds have also purchased huge amounts of Japanese bonds. With all this in mind, you can now better understand news such as this.
Why investors are worried about Japan's bond market. Trouble in the bond market had been brewing in Japan ever since the country's central bank started gradually trimming its balance sheet and scaling back its purchases. The problem is that other buyers have not stepped in enough to fill the gap left by the Bank of Japan.
The Bank of Japan has gone from being the government's best friend to becoming a real headache. The reason, it has said, enough is enough. During decades of deflation, the BOJ did not waver. It bought Japanese public debt as if there were no tomorrow. Japan is facing inflation of 3.5%. By Japanese standards, that's like a runaway fire. And clearly, continuing to buy public debt in this context would be like throwing gasoline on that fire. What has the Bank of Japan been doing until now? It's been buying bonds, increasing demand, and making it very cheap for the government to borrow. But that's over. The BOJ has turned off the tap, and no one else is stepping in to fill the gap. Remember the insurance companies, that pillar of the Japanese market? Well, the four largest have reported losses of $60 billion in bonds in the last year alone, 4 times more than the previous year. So obviously, they aren't very keen on continuing to buy government debt like crazy either. And what about foreign investors, the ones who were driving the market at the beginning of the year? They are also fleeing. The result, government bond rates have shot to levels not seen in decades. And in case anyone needs a quick lesson, the rate on debt is the interest the government has to pay for someone to lend it money. The higher that rate goes, the worse it is for the government. Check out this fact. The 40-year bond started the year paying 2.6%. Now, there's no way to sell it unless it offers 3.7%. And many of you may be wondering, okay, the Bank of Japan is pulling back so it doesn't keep stimulating the economy, but why doesn't the rest of the market want to buy Japanese debt either? Good question. Historically, Japanese insurers and pension funds have preferred to hold part of their money in dollars because Japanese bonds paid very low interest rates. But wait, that doesn't mean they didn't buy Japanese debt. They bought it by the bucketful. But they also secured a large part of their balance sheet in dollars. Remember this detail because it will also be essential later on. But now that interest rates are no longer negative or zero, public debt auctions continue to fail.
Demand for long-dated Japanese bonds hits 14-year low on PM resignation fears. The bid-to-cover ratio for Wednesday's auction, a measure of demand, was 2.127, the lowest for a 40-year Japanese government bond since 2011.
Why is there no private demand for the new debt? This is where the third point comes into play. If Japan hasn't had it easy in recent decades, now things are downright terrible. For years, the Japanese dreamed of putting an end to deflation. But you know what they say, be careful what you wish for, because it might just come true. These days, Japan has inflation, but the economy still isn't growing. The cost of living is rising, while wages remain completely stagnant. And to make matters worse, the rice shock has arrived. Yes, rice. This staple ingredient on almost every Japanese table has doubled in price. The culprit? We could devote an entire video to this topic, but the short answer is an explosive mix of poor harvests and even worse government decisions. Given this situation, the opposition kept pressuring former Prime Minister Ishiba to cut or even completely eliminate the VAT on food, and maybe other taxes as well, to try to stimulate the economy. But poor Ishiba was caught between the sword and the debt, and in the end, he chose the sword. If he lowered taxes, he would collect less revenue, and its ability to pay back its massive debt would shrink, and investors would demand higher interest rates to lend money to the government. But if he didn't lower taxes, then the cost of living would keep rising, social unrest would grow, the governing coalition would start to wobble, and Bingo, that would also send Japan's risk premium soaring. In short, there was no other way out for Ishiba, and not for Japan either. And at this point we need to make one thing very clear. The market isn't so much concerned about what the government is or is not doing right now, but rather about what will happen in the future. We know this because the gap between Japan's 30-year and 10-year government bonds has widened far more than in other countries. Because yes, the rice crisis is a one-off. Even the 3.5% inflation rate could ease. But what will happen in the next crisis? And how will all these current problems affect long-term growth? As we've mentioned several times on this channel, Japan's true Achilles heel is its aging population. And if we don't understand this, we can't understand the debt crisis the land of the rising sun is facing today. If we look at GDP growth per worker, Japan has done wonderfully well. It's one of the champions of the developed world. But it doesn't matter how productive they are if there are fewer and fewer workers. Winter is coming, and with it, the old familiar problems, debt and interest rates. Because yes, interest rates also play a key role in this story, a role you probably didn't expect. Japan kept rates negative from 2016 to 2024, and just raising them to 0.25% a year ago caused a financial earthquake. Today, they're already at 0.5%. And in case anyone is confused, we're talking about the central bank's interest rate. It's not the same as public debt rates, but they are closely related. So what did the government do with those ultra-low rates? What in Argentina is called the financial bicycle, or if you prefer the technical term, carry trade. This basically consists of taking on short-term debt to invest in the long term, and on top of that, borrowing in currencies that don't depreciate as much as the yen. That way, the return is higher. Mind you, this move is not exclusive to Japan. A lot of countries do it, but only a government can play this extreme version due to the duration of its bonds and the fact that it doesn't need to worry about exchange rate or liquidity risk. And the truth is that, so far, it has worked out perfectly.
Japan's government has realized an ex-post excess return of about 2.13% per annum above its funding cost by going long in long-duration risky assets, financed with mostly short-duration funding in the form of bank reserves, T-bills, and bonds. This investment strategy has allowed the government to earn more than 3% of GDP from its risky investments.
The problem? Well, there are actually two. The first is that if the bicycle slows down or reverses, what was a very profitable operation can become a death trap, and then it's a case of goodbye profits and hello debt. But the second problem is more subtle. To keep this bicycle pedaling, the government needs to keep interest rates very low. And who benefits from that? The elderly. They have assets, they are exposed to long-term bonds, and the state can continue to pay their pensions at low cost. But what about young people? Well, they have a tough time. Their savings yield almost no return. It's more difficult for them to accumulate capital for the future, and since they hardly invest in sophisticated financial products, they depend on bank deposits that pay laughable interest rates. This is called financial repression, and it consists of a government limiting the wages or investment capacity of part of its population in order to finance itself indirectly. In short, keeping rates low today means giving fiscal sustainability some breathing room, but at the cost of stifling the economic future of young people. And now comes the big conclusion to this story. Raising rates not only makes debt more expensive and cools the economy, it also leaves older people behind, who will see their incomes and pensions lose purchasing power. So what choice does the government have? Either it lets them lose purchasing power, something that is politically suicidal in an aging country, or it raises taxes to compensate them. And you know what happens when taxes go up? The economy suffers. Young people become even more angry with politics, and the risk of debt skyrockets. If this continues, the Japanese government could be forced to sell some of its US Treasury bonds to plug the gaps. Remember, Japan is the largest holder of US debt in the world. And what happens when someone floods the market with bonds? Exactly, their price plummets. And I don't need to tell you what a sharp fall in the price of US debt would mean. We're talking about the lifeblood of the global financial system. Uncle Sam would have to raise interest rates to compensate for the excess debt in the market, and that would plunge the country into recession. And you know how it goes. When the US sneezes, the rest of the world catches a cold. Now then, hold on a minute, because there's still one piece of the puzzle missing. A piece that changes everything. To begin with, yes, Japan is the largest holder of US debt. That's true, but that doesn't mean it holds all the cards. In fact, Japan only holds 13% of the US's external debt. And if we're talking about total debt, the figure drops to 3%. Is that a lot? Well, yes, of course. But even in the most apocalyptic scenario, in which Tokyo had to sell all of its bonds, the impact on the markets would last no more than a few months. In fact, this isn't even the reason why you can sleep soundly tonight. The real reason has to do with the Japanese pension funds and insurance companies we mentioned earlier. Remember, for years, they invested outside Japan because Japanese bonds offered virtually no return. But if the Bank of Japan continues to raise interest rates, then Japanese money will start to flow back home. And what happens when demand for Japanese bonds increases? Exactly, their price goes up and interest rates go down. No one knows how low they can go, but the Bank of Japan, the Ministry of Finance, and several private consulting firms agree on the essentials. This repatriation of capital is more than enough to keep rates under control. So yes, Japan is going through a difficult time. Its finances are under pressure, and the government has to pay much more than expected to place its bonds. But it's likely that the Japanese themselves will end up stabilizing the market by repatriating their money. Even so, let's not kid ourselves. This is not a magic solution, because the underlying problem remains. With an increasingly aging population, social security spending leaves little room for much else. And as Master Yoda would say, lack of margin leads to political instability, and instability leads to the dark side. In other words, to debt. But now it's your turn. Do you think all these problems are temporary, or is there really an underlying problem? Will the Japanese government manage to balance its public accounts without causing a recession in the economy? To what extent do you think Japan's problems could spread to other countries? You can leave your answers in the comments. Don't forget that here on Visualeconomik we release new videos every week, so subscribe if you haven't already to make sure you don't miss any of our upcoming episodes. If you like this video, hit like, and I'll see you in the next one. Cheers. See you next time.